Thank you, Steve, and Secretary General, for these words that were too kind. I may have designed and managed this project and wrote quite a bit about it, but the fact remains that this was a collective effort. There were more than 30 people involved in producing this. There are 17 reports that support the synthesis that you see available there, which will be produced subsequently because we have overloaded the capacity of our communications department. And they're all good papers. So in those papers that will come out subsequently, you will be able to find a more detailed analysis, literature reviews, and so forth. That said, because there was not enough space in the report itself, I'd like to extend my thanks and support, like you said, Secretary Young Tae Kim, the previous secretary for encouragement, both of them, the communications team, and of course our assistants. They are like infrastructure. We don't particularly pay attention when we take a ride on the road, but if something goes wrong, you immediately know that you have a problem with the infrastructure. So good assistants are essential. That said, let me now quickly provide an overview of what we did. I'll set the scene, and then in 4 individual blocks that will follow 4 sessions, we will discuss 4 major parts of our work, engaged in dialogue with the industry, with academia, with practitioners, with the public sector. And that is actually one part I'm most satisfied with, that we managed to create a body of work that draws from all these parts, even though it's by definition impossible to consider every possible perspective. Thank you. Okay, so what I will do in this presentation, I will go through the basics of what is the role of private investment, take stock of the evidence that we reviewed, give you a brief overview how we mapped out how uncertainty is relevant, and provide a basic overview of how private finance handles uncertainty. And then the guidance is in the report, and some of it will come out in the sessions. So, in the past, when people have been talking about private investment, it was always comparing the public sector from 10, 20, 30 years ago, when things were not so well organized. Since much of our work in this report has focused on advanced economies, the public sector is quite advanced itself today. So this is an example of a state-owned infrastructure company that collects its revenues through tolls and fares from the users, finance itself through corporate finance, and uses performance contracting for construction and maintenance. And this structure is present in very many European countries today. It works quite well. So when we're considering what private investment can do, we think that the counterfactual is this. So what can the private sector do that makes the performance better than this? And then the key partial response to that question comes from this. This curve here is the index of maintenance expenditures on road infrastructure that ITF collects annually. And you can see that up until 2009, when economy was more or less working well, and the effects of the global financial crisis were not yet so pronounced, money was available, and when governments got into fiscal distress, maintenance and investments were the first to be cut. This is not a problem per se. Every country government needs fiscal flexibility. Economic cycles goes up and down. The problem is that no government starts its mandate with a public infrastructure balance sheet that would say, these are our assets, this is the quality of our assets, and when it leaves its mandate, it would do a closing statement saying, this is how much we've built, this is now the new quality of assets and the debts and liability of the money that we borrowed from the infrastructure. It's a problem of consistent behavior. Governments tend to forget that they borrowed money from the infrastructure and that they need to give it back. And when you engage with the private sector, you commit yourself to make that transparent. So in terms of the evidence, we reviewed everything for the transport sector and a little bit also outside, namely utilities. And the evidence that is available today is generally positive for seaports, generally positive for airports, very limited for railways, and not compelling for motorways. And when I say positive, the results are good when you have a rule of law, when you have good institutional capacity, and a sound incentive mechanism, symbolized here by a carrot and a stick, so everybody can understand that. In terms of what more is then the role of the private sector, apart from the countervailing pressure to government inconsistency, our analysis shown that the primary benefit of involving private sector, when you get it, is productive cost efficiency. It cannot help improve project selection, at least not in transport, and it does not extend the public borrowing constraint. It's not free money, and that's a eternal confusion for politicians, the distinction between funding and financing. So understanding why we use private investment is essential, and we need to be able to explain that to the general public. And an essential part of this is much of the private investment, or almost all of it, happens through public-private partnerships for transport, I'm speaking. An essential part for that, for public-private partnerships, is there must be good competition for the contract. The second condition is there needs to be credible commitment for the contract, both from the public and the private side. And once we have that, we need to collect evidence for that it works, that it gives us a better performance if it does. We need to make that evidence available to the general public. And if the general public accepts that, then we can have a virtuous cycle which is sustainable and can be continued over time. But if we don't have the evidence, even if it works, then we cannot convince the public. The public will revolt. It will exert political pressure on their governments, and the governments will find it difficult to commit to contracts. It doesn't necessarily mean expropriation, but it may mean that pipelines will dry out of new projects. So it's essential for a sustainable approach to private investment. Then we can prove that what we're doing is working well. So, us knowing that it works is not enough. We need to show that it works well, and we need to be able to explain it. This may be one of the reasons why private investment in infrastructure in the past 20 years has been generally concentrated in only a few countries. So it's not a financing problem, or it's not a capacity problem, that most of the private investment in transport infrastructure or infrastructure in general happens in a few countries. In this particular case, it's 8 or 9. It's a problem of public acceptance. Okay, so I've given you the basics how private investment might matter, what its role could be. We will talk about efficiency, and now I'm going to give you a brief overview how uncertainty matters. Every contract does two things. First, it transfers a little bit of risk depending on the contract type, and that risk drives two things. One, efficiency gains, and the other thing is when the bidders or the winning bidder accepts the contract, he needs to price the risk that he is accepting. And if the efficiency gains are bigger than the price he's charging for the risk that is transferred, then we get value for money, or something better than from what we had before when we transferred less risk. In conventional financial economics, it has been believed that it is the market that can often create this information about risk. So if you take this curve, at the beginning, at the left-hand side, there have been a few pioneers that invested for the first time in the market. They had no clues about potential returns and risk, and they made their bets. and some won, and some lost. So some made huge profits, some made huge losses. The next generation coming after them benefited from that information. The next generation coming after that one benefited more, and so forth. The market would create information where people would get an understanding what is the risk and return profile for a particular type of investment. This is the idea how the market would generate information in financial economics. For infrastructure, we have learned this has not worked. One of the major initiatives by the OECD and many international institutions is to establish infrastructure as an asset class. And the first indices for private sector investment are already available, all developed by the private sector itself. So if you have the information, you can assess the risk in projects better, and there will be less failures, but there will also be less abnormal returns. So there are 3 conditions for efficiency, not 2. First, you need to have credible commitment for the contract. Second, you need to have competition. And third, you need to have information about risk. This is supposed to illustrate how not having information matters. Essentially, it means that people are afraid of not knowing, and this is a basic psychological reaction. In a public-private partnership, for example, much of the international focus is on the investors. And this is normal because they are the people with the money. But most of the value in this approach happens by the suppliers. And they are the ones that bear much of the risks which investors are not comfortable bearing. And the information problems that investors have, suppliers have much more. So they have a bigger problem, not that they have more information. To provide you with an example, this is a single study that benefited from the benevolence of the French bank Natixis, that allowed us to assess with a colleague in 2013 that investors were successful in insuring against construction risk in PPPs. It means that using fixed price and fixed date contracts in PPP for construction, on average, the cost overrun was 0. How can you achieve an average outcome of cost overrun 0 with very little variability on a project that costs 100 million, 200 million, or $1 billion, that has some tail risk that nobody can assess? You see, you can't. Nobody knows what is the exact cost of a 200 million project or a 1 billion project or a 2 billion project. Even when the risk assessment and identification process is very diligent, which is in the construction industry done in workshops, and then a Monte Carlo analysis is run, and then they get such a nice curve of the probable risk distribution of the expected cost of the project. And maybe they find out that the expected risk of cost overruns is maybe 2% on average. If then they take this result to the board of directors, they will say, this is too low, we're not accepting this. And they will say, we need 10, and then we'll feel comfortable. Because they know that the whole exercise is subjective. They don't have deterministic data that you would throw in the computer, and the computer would spit out a precise distribution, and then you can build a precise portfolio. That never happens in real life, not for suppliers, not for investors. There's always an element of uncertainty, and the more uncertainty we have, the bigger the fear and the greater the aversion. This is a second example that you will find in the report from a paper that was published first in 2017, but now it's in print. It compared all the studies that were available and a single study published on the European motorway sector to compare end construction cost on European motorways that were built, well, now 10 years ago, I think, no? And more. And it it found out that yes, you get a far lower cost variability for PPPs because they use the type of the contract that I just mentioned, but the overall cost is about 20% higher even when you consider the cost overruns in traditional procurement. And this is a prime example of the cost of certainty. And of course, there's a background debate why this is so, but that infrastructure was not actually of higher quality. You couldn't explain this result with with other potential explanations. Now, the uncertainty I just mentioned in the case of construction has to do with complexity, our inability to provide a very precise estimate what a very complex and large project will cost. There are other aspects of uncertainty, especially over the long term, as contracts for infrastructure tend to last a very long time. And this is an example of a study or a vision at my own institution, where colleagues have played with the idea how shared mobility and automated vehicles might affect transport and job accessibility in the city of Lisbon. And it has a number of theoretical assumptions that in practice are probably not palatable, but it shows that if sometime in the future we had taxi bots that would drive 8 or so people, have people wait for 5 minutes or so to get to their next taxi, be comfortable with sharing the rides, that you could reduce the vehicle fleet by 90% or so. So we don't know whether that is it's unrealistic given the cultural aspects of people, but it's an example potentially how the future need for infrastructure may be affected by changes in technology, potentially in culture, and we actually don't know. There are many reasons that might increase the transport on future motorways, or they might decrease it. The automated trucks will be able to drive day and night. They will not be subject to driver tiredness, for example. So there are things that happened over the long term that nobody can predict and that might affect the contract that we sign. And in some cases, that can lead to a hold-up problem where you can't sit with your partner, the private partner at the table, and have a balanced discussion what to do with the new situation. Maybe you need to do something fast, but the private partner is good as it is, or vice versa. And that's not good for the general public benefit. And lastly, how uncertainty also matters is on competition. Those who are already in the market have superior information to those who are not yet there. There's at least one study available that shows that if you provide more information to the market, you can get more bidder interest, more entry, and bidders will stay longer in the market. So this is also something that depends on how the public sector equips the market with information. To summarize all this together, we have a nice scary figure that affects risk pricing, which was the funnel I talked about before, that affects competition, which is something I just mentioned, that has a knock-on effect on risk pricing, because as I said, one of the conditions for that funnel to function properly is to have competition between bidders. And then we have circumstance surprises over the long duration of the contract. And all these questions need to be answered. What works where best? And one of the conclusions or suggestions of our work is that especially the long-term uncertainty and risk pricing challenge will face serious difficulties in the case where the entire contract solution and the efficiency incentives depend on a single competition for the contract. When there is no other pressure to be efficient, no other pressure to erode your rents throughout the contract than a single competition for the contract at the beginning. And I'm simplifying here because most of these contracts have formulas and so forth, but that's not enough. And then there are other examples, other markets, where there is a single competition for the contract, but then there is continuous pressure throughout the duration of the contract, either because there's a competition in the region, like in a catchment area where several ports are active, or the demand for services is strongly endogenous. Perhaps on a passenger train line, and a contract that does not last 15 years maybe, but lasts less, where the service quality can strongly affect whether users will come on that train or not. In other places, so market type A, which I mentioned, there will be a problem with risk pricing, and it's not unlikely that the inefficient risk pricing will actually offset the gains of efficiency that we might get. So we have thought about these problems. We have thought about some solutions. With regard to the complexity and competition, Athena will continue with the first session, how competition is handled in the European Union in terms of major infrastructure projects. Is it working? Is it not working? Is there anything that we can do about it? And why isn't it not high on the political agenda? Second, Aris will run his session, and he will talk about what we can do with regard to complexity in the construction phase, explaining what the government can do to improve the performance of the contract or reduce the inefficient risk pricing on the bidder side. And in the third and fourth session, we will have a discussion what we can do with the existing PPP model if the countries want to stick with it on the markets where we suggested that is not the best idea, to equip it with partial fixes and how those partial fixes work. That will be run by Alex. And in the last session, Steve Alchin next to me will run a session on a debate on an alternative model for those markets where PPP might not work very well, which is called the regulated asset-based model, that is known, regulatory asset-based model, that has a long history in the utility industry, but has been applied to a very limited extent in few cases in transport, especially networks. And what that model does is it has a very sound structure for renegotiations, and it breaks down a very long period of 20 years or 30 or more into a series of shorter price reviews, exposing the private sector to a smaller problem of inefficient risk pricing. And also what the regulator does, because there's a regular institution present on the side that collects information, does benchmarking, a public agency can engage in a much more balanced discussion with the private sector when it needs to renegotiate serious things. And that is a completely different approach from a PPP, where the government is only a contract manager and faces information asymmetries when there's a need to renegotiate. So far, so much from my side. We will see each other again at the end, where I will give you an overview with my colleague Adrian on what the future might be after this. So thank you.